Turnover, gross profit, net profit and EBITDA. A while back I was watching an episode of Dragon's Den that reminded me of the confusion that abounds around the words turnover, gross profit, net profit, profit margin and a whole bunch of other terms that have everything to do with how you view the profitability of your business. So let's have a look at turnover. This is your total sales figure, literally in money terms, how much you sold during a particular period, which is usually your financial year. So let's have a look at gross profit. If all you sell is a service and there are no costs directly involved in supplying that service, then your gross profit is the same as your turnover. However, if you resell other people's goods or services, manufacture things for resale, or do have costs directly involved with what you do, then you need to remove those costs from your sales in order to arrive at your gross profit. Typically, these costs will be held in an account called cost of goods sold. If you sell mainly services, this is often simply shortened to cost of sales. Here's a simple example. You buy a widget at a cost of 100 and you resell it for 200. If you sell just one of these, your turnover will be 200. However, your gross profit will be 100 because you must subtract the cost of the goods sold. Your gross margin, using the previous example, will be 50%. Gross margin equals selling price less cost price divided by selling price. Let's have a look at markup. Again, using the previous example, we marked up the product from 100 to 200, which equals a 100% markup. And your net profit? Well, there are multiple versions. The bottom line is your turnover less all costs. Your costs are not only COGS and overheads, but also depreciation of your assets, any amortization of loans, and of course your tax liability on the profit made. Accountants use different abbreviations to show exactly what degree of profit they are reporting. The most common is EBITDA. EBITDA stands for earnings before interest, taxation, depreciation and amortization. In other words, your turnover less your cost of sales, overheads and other expenses. You can quote on any subset of this. For example, EBIT equals earnings before interest and taxation. Learn the above and you will impress any investor and bank manager.